dealing with risks. Risks are an important element of all project finance transactions, and in fact are one of the large reasons that this financing is taking place through a project finance structure rather than some other structure. Project finance is great for risk mitigation and risk isolation. So we can talk about risk sharing, and we can talk about each of the parties in the transaction. We've got the asset user or off-taker, which I'll refer to as the customer, assuming that we're the developer. So what is the customer responsible for? Well, they need to make the payments, so they actually are able to get out of a lot of the obligations that come with owning an asset. They don't need to think or spend as much on maintenance, if anything. They don't need to think about renewal or repair. They don't need to think about construction. And the only financing discussion they need to have is with us, the developer, to make sure that their credit is suitable to work in this project finance structure. They generally do need to have pretty good credit because if you think about it, if they're going to be signing a long-term contract, that's a lot of risk to be putting right on them as repayment. Unless, of course, the asset can be shifted to someone else very easily. Or there's insurance that can provide additional coverage. So they have a risk to them of defaulting on the payment. That risk also, of course, is borne by the lender and the developer. But there is a risk that this will overextend them and they will default. There's also a risk that since they have less control over the assets, they may not be able to meet efficiency or reliability requirements. The developer, on the other hand, has different risks and different responsibilities and rewards. So the developer is facilitating the project development and the financing, but shifting the financial risk through these structured repayments to all the other parties. At the end of the day, the risks do tend to fall back to the developer and filter through, but there is a lot of protection and coverage and separation before it gets to that point. They also may outsource various operational responsibilities to specialized firms. You may have a developer. That developer may or may not do the construction, may or may not do the engineering design, may or may not do the procurement of key equipment. That's up to the developer, and it's up to how they deal out all the various parts of the actual project development process. They manage the operational risk, though. That's making sure construction goes right. If they're not doing the actual construction, they're still holding the bag for the execution. They're holding the bag for equipment breakdown, long-term success and profitability of the project. Generally, if the project goes bad, it's the developer who must lose the capital first before the lender. And the lender has covenants like debt to equity ratios and debt service coverage ratios that protect them and make sure that the developer is sitting in front of them so that they are at risk before the lender is at risk. The developer themselves have funding risk. They may not be able to raise the capital. They may put the project together, spend a lot of their own money to put this project together as well, maybe on engineering, maybe on plans, permitting, designs, maybe just staff time, and yet they may not be able to get the funding. That's an important risk, as well as regulatory risk. They may have a project put together and fail to secure the permit, or if the project's not completed in time, or if the local government is structured such a way, they may lose their permit at some point in the process, and that can change a lot of things. Next is the debt capital provider. They're providing capital and thus at risk, and to a large extent they are taking a lot of risk here, but they're securing that with collateral and repayment agreements and a whole lot of legal agreements that make sure that they're protected. They are distributing their risk through these structured financing mechanisms, through underwriting of all the key elements of the deal, from the customer to the developer to the equipment provider. The debt capital provider will want to know about all of these things. This is what gets them comfortable actually doing the deal. Their biggest risk is default risk. If the borrower fails to pay, either due to insolvency of the borrower or to failure of the equipment or any other reason that causes the borrower to be unable or unwilling to pay. They also have collateral risk. They may be secured by certain collateral in the assets or the contracts, but if that collateral is to fall in value or be impacted, say through a force majeure event, they would be in a loss situation. That is why insurance is also important here. Now, last but not least is market risk. This is why long-term, predictably priced contracts are so important. If you signed a solar power purchase agreement that floated with the price of power over the course of its life, you may wind up with a low power price 10 years from now. How would you even know whether you have enough money to continue to repay your debt? On the other hand, if you signed a fixed price contract or a contract with an escalator, that can be used to secure the long-term cash flows of the project and thus ensure that the capital provider can be repaid. There's also the equipment provider. They bear a bit less risk in these transaction structures, but still important to note. They're supplying the asset, they're not bearing the financing risk. They ensure quality of the equipment, and they do hold warranty obligations, but they shift the financial risk to the buyers and the lenders. They just want to sell their product. They do have production risk, though. If there's delays, cost overruns, or supply chain disruptions, they may need to bear some of that cost if they hope the project is to continue. There may be technology risk in that their system may not produce up to specifications, or it may become obsolete during the process of project development. Also, market demand risk may affect the amount of supply that they have on hand and the ability to deliver that supply in the proper course of time required for the project. There are other common risks associated with these projects. Recognizing and categorizing these early in the life cycle helps to mitigate problems down the line. Permitting and planning risks are always key and can be mitigated by starting early. Casualty or force majeure risks also come into play, and insurance is the major element of covering those risks, as well as having an additional supply of cash if possible. Maintenance and cash reserves and insurance go a long way to handling these issues. Thinking about pricing and minimum prices of contracts, building in a buffer to make sure that should there be cost overruns, you've got extra returns, extra capital coming back in, all help to mitigate the risk. Modeling and planning is an important part of this, and there are risks that it's not done correctly, but if done adequately, guide the entire process.